Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we're talking about state taxation of interstate commercial activity. We're primarily talking about the shifting sands beneath a long-standing federal tax law for determining if a state can tax the income of business. We're limiting this discussion to income taxation today. Lots of other ramifications in other state and local taxes, but income tax. The star of the statute for today is Public Law 86-272. It's been around since 1959, but the way companies conduct business today versus the middle of last century continues to put pressure on its applicability and how courts and taxing authorities and businesses define doing business in the state. So, joining today's conversation are Lewis Cole, partner and leader of our state and local tax consulting practice, and Kathy Shaw, partner with our firm's national tax team covering state and local tax issues. So, Lewis, how are you doing today?
I'm doing fantastic. How are you, Brooks?
I'm doing great. And where are you sitting today, Lewis?
Atlanta, Georgia is where I reside.
All right. And Kathy, how's it going today?
Pretty good. Nice and sunny up here in Ohio.
We're all jealous. We're getting dumped on in the rain down here in the south the last couple of days. And joining me, my partner in crime, as always, Sarah McGregor from Greenville office. Ms. McGregor, how's life treating you?
Life is good. It's almost time for another holiday and the start of summer. It's pretty exciting to be talking about state tax nexus issues.
All right, let's do a little bit of background before we start the conversation. Public Law 86-272 prevents states from asserting the authority to tax a business for income taxes if the business is an out-of-state tax seller of tangible goods and the business limits its activity within the state to the mere solicitation of sales. That's a mouthful. But anyway, stepping forward to 2021, when the Multistate Tax Commission provided a reinterpretation of what activities go beyond the mere solicitation of sales, then things start getting more complicated. MTC's guidance suggests that the use of the internet for post-sales communications or to drop cookies for data mining or request resumes are activities that are not mere solicitation of sales. Companies can then be subject to tax by that state. All right, lots of complicated concepts in there. But before we jump too far into 86-272, let's explore a term that Sarah just mentioned, nexus. So, Kathy, how about giving a layman's definition of the term nexus?
Yeah, so nexus is like a disease. You don't want to catch it. It's really hard to get rid of once you do catch it. But nexus simply means you have enough connection with a taxing jurisdiction to become subject to the tax. So if you have enough connection, they're going to tax you. So you don't want to have it if you can get away with not having it, just like a disease.
All right. Well, I think sometimes you might want to create nexus if it's to your advantage, though, right? It's not always.
That's a good point.
Not always terrible, but anyway, but 99% of the time. All right. So, Lewis, for background, let's go to Public Law 86-272. Which businesses most benefit from this law and which companies do not?
Well, 86-272 protects companies that sell tangible personal property. So manufacturing, distribution, retail type of clients may get the protection depending on the activities that they perform in a particular state. Service companies such as software as a service or SaaS, combined sellers of property and service at the same time. If you're only selling tangible personal property, you may qualify. If you sell anything else, any other services, it's very clear you would not qualify. And a lot of companies like retail and manufacturing distribution clients have used 86-272 for planning purposes for a lot of years. So The states don't particularly like companies using any method to not pay taxes in the states. And so now they are continuing to erode 86272 through a variety of different activities. So we'll talk about those as we go through the discussion.
Great. So Kathy, you define nexus for us. Could you help us out with the Multistate Tax Commission? What is that, and what sort of authority or influence do they have?
Yeah, the MTC is a quasi-governmental organization. So states can choose to belong to the MTC as a full member, associate member, or they don't have to be a member at all, but they can adopt some of the model statutes that the MTC comes up with. And so what happens is the MTC chooses certain projects. They try to bring uniformity to all state tax laws, and there's really a self-motivation there, because if they don't have enough uniformity and states become very difficult to work with and comply with, you could have Congress stepping in and enacting laws, just like Public Law 86272. So it's definitely to their benefit to bring some uniformity. So the states get together and they discuss how things should be structured within the states, and they try to adopt similar model statutes. But the MTC itself doesn't have any authority on its own. The states have to adopt the laws, model statutes, regulations that the MTC comes up with into their own statutes and regulations in order for them to be authoritative.
Well, then, Lewis, have any states adopted the MTC's interpretation of doing business that's causing a lot of concern here about internet-based activities?
So there are a number of states that have adopted the MTC interpretations of doing business, and that would be California, New York, New Jersey, and several others that have it on their agenda as we speak. As Kathy mentioned, states are free to pick and choose their level of MTC activities that they adopt. Many states are very aggressive in eroding the effectiveness of 86272 protection, and this is just another bite at the apple. They also share information with other states that are also financially strapped and are looking at ways to expand the roles of the taxpayers.
And I would say, even if a state doesn't adopt it at all, right? This Public Law 86272 is a federal law. The states are only interpreting the federal law. So they don't have to adopt anything and still apply that interpretation. So it's very interesting. Like California, they issued guidance that has been recently struck down in the courts because they didn't go through the proper regulatory rulemaking procedure. And I'm like, and they're going to apply it retroactively too, which is awful. And I sat on a lot of these MTC calls discussing this revised guidance, and they were clear that they didn't believe states should be applying it retroactively because everybody thought these internet-based type activities were protected. And now we're changing and saying, no, they're not protected. Well, how do you go back and make that retroactive? It's not fair. Well, California is seeking to do that. And New York, the regulations became final, and there was just a lawsuit May 8th, just proposed by the same organization that sued California, trying to make it invalid. But in my mind, even if they make it invalid, it's still an interpretation, right? So it's just going to be interesting. It's going to be the courts decide, do you have nexus or not? Does this federal law apply or not? And so whatever interpretation, Vermont, they put it in their instructions. We adopt the MTC, in their instructions. That's not authoritative, but they're just saying what their interpretation is going to be. But I just want to comment, the thing that most practitioners, including myself, have a significant problem with is that the telephone's been around a long time. The federal law was enacted in 1959. Since 1959 forward, people were calling, asking technical issues, post-sale information, sending resumes by U.S. mail. All of those things never created nexus. The states themselves never considered those actions as creating nexus. But now, all of a sudden, because you're doing it VoIP, voice over internet, or you're doing it just through a chat or an upload, all of a sudden, that's business activity that's occurring in the state. We're having a really hard problem with that. And I think the courts are going to have a significant issue with that as well. Unfortunately, at the end of the day, it's always the attorneys that make out in these situations.
Well, Kathy, I don't want chaos, maybe too strong a term, but I mean, certainly a lot of confusion. Well, how do you see this confusion affecting small and medium-sized businesses that they can't afford a team of attorneys and 20 accountants? Yeah.
And that is my biggest, most significant concern. Because especially you have small business or even individuals that are just selling one item, right? Maybe selling one item over the internet, never leave their state. But then they get really successful and they're, some substantial sales, but they're just selling into the state. Traditionally, Public Law 86272 would always protect them. But if they're having any post-sale chats on the internet, they're saying, nope, it's not an economic nexus issue. It's a physical presence issue. They're saying that you have physical presence in that state because you are utilizing that communication channel in that state. And so you can have a small seller and sellers that have huge losses. And all of a sudden, this public law has been taken away from them, that protection. Now they have to file in all these different states. And you know as well as I do that state tax compliance isn't cheap. and also, if they have a sole proprietor tax preparer, they usually only know their state that they're in, or maybe a couple states that are surrounding. All of a sudden, if this small business has to file in all these different states, their tax preparer is going to say, we're not familiar with any of those states. You're going to have to get another firm to do your taxes. So they have to come to a Cherry Beckert that charges more than that sole proprietor. So not only the tax compliance cost, but the systems cost of tracking all of this, they could have losses. It's just terrible. So from my perspective, and I'll just move on to my thought on how to potentially remediate that, would be to call on Congress. And I wrote an article on Bloomberg Tax for this, but to call on Congress to set safe harbors. So not just thresholds of exceeding that create economic nexus, because this is more of a physical presence issue that they're taking, but having a safe harbor. If you don't exceed the sales amount, you do not have to file a return. So only Michigan, to my knowledge, really has that kind of a safe harbor where they say if you don't reach $350,000 of sales, it's okay. But otherwise, either physical presence or a substantial amount of sales are going to create nexus.
So, Kathy, you just talked about how this was expanding for sellers of goods. Well, what about the issues for companies that don't sell tangible goods? Do they already have these nexus issues? Is that what they already are facing this compliance nightmare?
Yeah, that's a great question, because Public Law 86272 only applies, as Lewis said in the beginning, to sellers of tangible personal property, right? Not services, not technology, anything like that. So you don't have any protection from public law. So then you get into the issue of, is the connection with the state substantial under constitutional standards? So it really comes down to U.S. constitutional standards, which under complete auto transit requires you to have a substantial connection. So what's substantial? That's in the eye of the beholder. So what does that mean? If you have just one post-sale chat, even for tangible property, is that substantial? What is substantial? Is it a certain dollar threshold? From our perspective, when we're looking at nexus, we're looking at some of those Wayfair thresholds, really, because the U.S. Supreme Court had said, at least for sales tax, which is different than income tax now, but at least for sales tax, they're saying 100,000 is substantial. So on the income tax side, we're saying, well, the U.S. Supreme Court has determined 100,000 is substantial for a connection. That likely will be the case on the income tax side too. But then, some like Texas enacted legislation that it has to be 500,000. So there are some states, but there's only about 12 or so that have given a specific threshold, like Wayfair. We really need those thresholds on the income tax side. But like I said before, in addition to the threshold, we need a safe harbor so that the physical presence questions don't come into play as well. But to answer your question in short, it comes back to U.S. constitutional standards. So yes, they could have nexus depending on if their connection is substantial.
So Lewis, taking this all to extreme, I mean, almost every business could sit there and say, oh my God, I have nexus everywhere. So Talk to us about what a nexus study is and why it may be a good thing for a business to do one.
Yeah, thanks, Brooks. A nexus study is that review of all of the activities that, if known, would subject you to tax in a particular state. And it's key to make sure that you look at a nexus study with eyes wide open and making sure that you answer the questions truly the way that the facts are instead of the way you wish the facts were. Realize that a company may still have a filing responsibility despite the fact that the state cannot impose a state income tax. So there may be minimum taxes that you still may be due. Also recognize that often if you don't file a return, even if it says 86-272 on it and you're not subject to the tax, the statute of limitations may never start. And so when companies go through an M&A transaction, this is one of the issues that they often look at to determine, have you filed in all of the states that you're required to file? Also keep in mind, an ancillary benefit to this is that there are additional taxes that are not covered by 86-272, such as sales and use taxes, franchise taxes, property taxes. Hopefully you don't have property in the state. And going through this nexus review would also lead to identification of those issues, which, by the way, sales tax in an M&A transaction, of course, is one of the largest taxes that people often miss and didn't file correctly. And so going through this process with 86-272, a true nexus review with the facts all known leads you to a lot of additional benefits in addition to just determining if you have a filing responsibility there for state income tax purposes.
Okay, one drill down question here, Lewis, because I think this is kind of the scariest of all the topical issues here, is back to the internet activity. I mean,
That's right.
how, the whole record keeping, the analysis of what all this internet activity, what states are taking what positions with it. Are companies ready for this?
I don't think that companies really are ready for this because times have changed from the traditional salesman walking into a state, and technology has changed to where even if you don't go into a particular state, you may be subject to state income taxes because of the activities that you've got. I say that, technology changes have outpassed the traditional salesman activities, who have been historically protected by 86-272. And now a click of a button from a customer or a targeted solicitation while the client is on the website may be sufficient to exceed 86-272 and the solicitation activities. The good thing is that technology and internet activity lives on forever, it seems. And when you go back and the state comes to do a review and they test the activities that you conducted, they may be testing it where you have exceeded that activity based on what the states have said that you can do if you're soliciting people online. But you have to keep a record as to when that started, because it may not have started 3 years ago. It may have only started with the last iteration and update of the technology. So the companies will need to keep and maintain documentation as to what activities occur with each technology upgrade, because that latest technology upgrade likely is going to be the one that kills you.
So keeping copies of, what did your homepage look like? What did your post-sale emails look like to customers over a year's? Gosh, thinking, Kathy, you were talking about retroactive application. Who has all that information? I mean, what did your internet connection look like? Your internet interface look like 2 years ago?
And that's where the states are just very happy campers here, right? Because if you don't have the information, they'll estimate it for you. So, yeah.
Gee, what a nice
people.
customer-friendly service that they're providing.
That's great. Well, Kathy, what would you like to see the states? You mentioned Congress passing some laws. What about the states to help mitigate this compliance burden? Is there anything that they can do?
Yeah, and even in, the introduction, when the new interpretation was issued in August of 21 of the MTC guidance, their interpretation, they called on the states to actually implement safe harbors or some kind of threshold or some activities to protect small business. Because you cannot keep increasing just the cost of doing business, the barrier to entry, when small business just drives so much of the employment in the country. And I think so many times everyone's so focused on the large companies and they're escaping all of this tax to the detriment of the small business that can't even survive if this becomes so cumbersome and so burdensome to comply. And so the states can take steps themselves too to protect small business through those thresholds or through other relief measures, or even just giving like a hotline number that a small business could call and giving them some relief, a taxpayer advocate that can help in that situation.
All right, let's move on to final comments. So the floor is yours, Lewis.
I would say that nothing stays the same, and the states are in need of revenue, it seems, and they are all challenging each other to, again, erode 86-272. Looking at how the company has done business in the past is only one way to look at nexus. Things change. You may have acquired a company that has activities of its own. You may have started selling something that you didn't know, such as an extended warranty program that's going to change what you traditionally thought you did. And I find that tax departments typically know about 90% of the facts. And what's interesting is that it's the additional 10% that create a problem for companies that change things. So keep in mind business changes such as just-in-time inventory, where they move inventory to a new distribution center or outside of a particular client's location because they know Christmas is coming and they need to have that inventory more readily accessible, can blow tax planning. So again, look at your tax planning, look at it with your eyes wide open, understand the facts, and look outside of the tax department to find out what the real activities are. And I think that will assist you in looking at prospective planning that can still be accomplished through 86-272, though it's a lot harder than it used to be.
All right, thank you, Lewis. All right, Kathy.
Yeah, I mean, my biggest point would be don't bury your head in the sand. If you have nexus issues or you're concerned you could have nexus issues, address them before you get contacted by the state. There are ways to remediate where you only have to file a limited number of years. You get all the penalties forgiven. You can really, really mitigate the cost of compliance if you address it head on. If you wait until you get a notice, you no longer qualify for those programs to remediate in a cost-effective manner. And if you ignore and just say, it's a state across the other side of the country, I'm just ignoring it, there's no way I'm paying them, just know that states have reciprocity. They can lien your bank account. They can lien any bank accounts. So they will get their money. And when they estimate the tax, it's going to be larger likely than what it actually is. So definitely address the issues, know what skeletons you have in the closet. That way you can sleep well at night if you want to sell your business in the future. You're going to be squeaky clean. So definitely do not bury your head on these issues.
Good points, Kathy. All right, Sarah.
This is why I like federal tax, because there's only one authority I have to deal with and not 50 plus state authorities making up the rules differently each time they pass along. So, yep, I think I made the right career decision. But echoing what Kathy and Lewis said, knowing your potential exposure for states, particularly that state across the country is going to be much more inclined to assess out-of-state companies than they are in-state companies, because out-of-state companies don't vote in their state and don't have employees voting in their state, so it's much easier for them to go after tax that way. So I, as Kathy said, putting your head in the sand and hiding is not going to help you in this situation at all.
All right. Well, y'all have made some really wonderful kind of global observations. I'm going to take mine way narrow and tactical and say, if you hadn't got a nexus study done in the last year or two, and you have any sort of interstate activity, it's a good time to go get one of those done. Let's start at the beginning, something practical, something not too crazily expensive. And that's kind of a really good starting point and a good kind of hygiene check, I would say, state tax hygiene check. Okay, that's a wrap on today's discussion about tax reporting issues for state income tax and multi-state activities, particularly as it deals with selling tangible goods and doing business over the internet. It's a difficult topic to get concise, I think, in a few words here. But anyway, quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Lewis. Thank you, Kathy. And thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.